If you're self-employed and you drive your car for business purposes, then the vehicle deduction is a great deduction for you to add and save money on taxes. But there's things you need to know before going in to make sure you understand the vehicle deduction. I'm going to go over the top 5 things you need to know about the vehicle deduction to help you take advantage of the best possible way on that vehicle deduction. So first one I want to talk about is your first option. You actually have 2 options on how you claim this deduction, and the first one is going to be the standard mileage rate. So every year the IRS publishes a mileage rate, and that mileage rate we just apply against the total number of miles you drive your car for business purposes. It's a very simple option, and it's a great option for most people. If you have a high miles every year on your car for business purposes, then you probably are going to be better off with this mileage rate. If you have a lower costing car that you don't drive a lot, you still may be better off with this because you don't have a lot of expenses with the other option there. What's really required is you keep a mileage log of all your number of miles you drive for business purposes. There's a great app out there called MileIQ that I use that just runs in the background on your phone, and it's going to track all those miles, and you just need to note them periodically as a business mile or a personal mile, and then it'll add up all your miles. You can even do it across multiple vehicles. If you have multiple vehicles, if you're married with a spouse and you drive that spouse vehicle sometimes, then business miles just are business miles regardless of which vehicle you are. It's just the total business miles. So it's really the simplified method. It's great for most people. Number 2 thing you need to know about is actually the other method, which is the actual expense method. Now with the actual expense method, there's a couple things to keep in mind. One, you get to take all those actual expenses, including the cost of the car through depreciation, your gas, your oil changes, if you have to change tires, any sort of maintenance on the car, insurance on the car, registration, all that gets added together. Now there is limitations. You don't get all of those expenses. You have to take the percentage of that is business use compared to personal use. So you still need that mileage log. So that MileIQ I talked about, or any other app that you might use, or paper log is the same. But now we need to track all our miles to make sure we get that percentage of use on that vehicle. So it's probably not going to be 100%. So unless it's, you have a separate car that you are using for personal, even then it's really hard to justify that to the IRS. They're always going to assume if it's a personal vehicle that there are personal miles on that vehicle. If it is a true 100% business vehicle, we're probably talking about things like a trade plumber van, for instance, a delivery van for a cake business, maybe. Something like that would be a 100% business use vehicle. But if it's your personal vehicle you're now using also for business, you're going to have to prorate it. And the only way to prorate a vehicle is through miles. Putting your logo on the side of it or anything like that doesn't make it a business vehicle. The cost of those advertisings on the car, of course, are deductible, but the actual car itself, the usage is only based on the miles driven. This is a great if you have a really high-end expensive car that you're not driving a lot, so you can get a big the deduction that way better for you. The third thing is you need to know about through all this is you have to pick one. There's no double dipping. You don't get to do the actual expenses and then also take the mileage rate as well in addition, because that mileage rate, it really is meant to cover, based on statistical averages that the IRS comes with. or comes up with, depreciation, gas, all that on a per mile basis. They come up with that, and that's how they calculate that out. So you're claiming all those through that mileage rate, so you only get one or the other. Fourth thing you need to know about vehicle deductions is commuting miles don't count. So if you have an office outside of the home that you go to, that miles from your home to that office do not count as business miles. It's only when you go from that office to maybe a client or to the office supply store, those would be business miles. But just home to the office and then back home are commuting miles, and they are not deductible. The last thing you need to know about is how do you actually decide on these? And really, you have to run the numbers on both of them. And you got to look at how long you anticipate keeping this car, because the actual expense method is probably always going to come out better that first year, because you're taking through accelerated depreciation a large chunk of the cost of the car in that first year. But of course, then you get less of that deduction in later years. So you tend to do better that first year with the actual expense method, and you do better in later years with the mileage rate. So you need to run it out, estimate how long you plan on keeping it, how long you want to, or how many miles you anticipate putting on every year for business purposes, and what percentage of that is of the actual total miles on the car. So there's a lot of factors to go in there. Don't just get drawn in by that first year, that big tax savings. Make sure you're looking at the full life of the car. All right, hope that was helpful. If you want to talk this out, or first of all, if you have any questions, you can leave comments below. But if you want to get on the phone and kind of talk out your situation and which one might be better, I have a link below. You can book some time on my calendar. I'd be happy to discuss that with you. No obligation there in that call. But if you made it this far, give it a thumbs up, and thanks for watching.